Welcome back to the Gold Standard. I'm Marcus.
And I'm Sasha. Marcus, gold just did something it hasn't pulled off since May.
Cleared $4,700 an ounce, out close to 9% for the month.
And Kevin Warsh hasn't even stepped up to the microphone at Jackson Hole yet.
Which is part of why we're watching this week's PCE print so closely.
But gold's not even the wildest number today.
You're talking about silver.
Silver ripped 20% higher this month. One single day saw an 8.5% jump.
And Kitco's floating triple digits, $100 silver.
Is that analysis or momentum talking? We'll get into the case for it.
There's also a Treasury move sitting underneath both moves.
The bond buyback plan. I made Marcus explain that one in plain English before we hit record.
She wasn't letting me off easy.
Because stocks, bonds, and gold rallying together isn't the usual script.
And miners felt it hardest. Hecla and Coeur both jumped double digits in a single session.
Forbes has been tracking margins across the sector, too.
Plus some fresh financing news out of Nevada we want to reach.
So let's start where the money's moving fastest today.
Straight to gold, then. Sasha, let's trace this run from the top. Okay, gold just cleared $4,700 an ounce, first time since May. And it didn't take a straight line to get there. No kidding. Finance reported that number today tied to Ole Hansen's read heading into Kevin Warsh's first Jackson Hole appearance. Right, and separately, Reuters had gold hitting a 3-month high this morning ahead of the PCE inflation data landing later this week. 2 catalysts, 1 week. For the folks at home, Warsh is the name a lot of traders think becomes the next Fed chair. His tone at Jackson Hole gets read like tea leaves. And PCE is the inflation gauge the Fed actually watches closest. If it runs hot, that changes the rate conversation fast. So which one moves the needle more? Both, probably, but not equally. Warsh's speech is about who's steering policy. PCE is about how fast they need to move. Markets tend to weight the second one heavier in the short run. Fair. Now zoom out, because 4,700 isn't even the number that got me. Reuters through the Ukrainian outlet UNN flagged gold up roughly 9% this month alone. 9% in 3 weeks. That erases the entire summer slump. Adrian Ash at Bullion Vault had gold sliding toward 4,500 before this leg started. So we round-tripped a $500 drop and then some in 1 month. That's the part worth sitting with. This isn't a slow grind, it's a sprint. Okay, real talk. Rate cuts alone don't explain a move this fast. They don't, and buyers keep saying that out loud. Benziga's piece on the rally past 4,600 called it all about U.S. debt fear. Spot gold closed above its 200-day moving average even as long yields stayed elevated. Meaning gold's rising with yields, not against them. That's backwards from the textbook. It is. That pattern is the signature of debasement worry, not a simple rate trade. We saw something like it in the late 1970s. Gold ran while nominal yields climbed too because confidence in the currency itself was the real question. History doesn't repeat, but I'll let you finish that one. Add in the Treasury doubling its long-dated bond buybacks, and you've got the government itself signaling it's worried about absorbing its own debt, which is what pushed yields down and gold up 3.7% in a single session, according to Benziga's numbers on that buyback announcement. Right.
So, but what does that actually mean if I've got coins in a safe or I'm just holding an ETF in my brokerage account?
The paper gain is real, but the reason behind it matters more than the number itself. If this is debasement pricing, it's a slower structural trade. If it's fear ahead of Jackson Hole, some of it unwinds fast once Warsh actually speaks.
So don't get attached to 4,700.
I don't do short horizon calls on this show, and I'm not starting now. What I will say, the miners are finally catching up. Forbes and U.S. funds both flagged the gold miners index up over 20% recently, way ahead of the metal itself.
Margins widening while the metal runs, usually a late cycle tell, not an early one.
Watch 3 things this week: the PCE print, Warsh's tone at Jackson Hole, and whether miners keep outrunning bullion.
Because if gold's 9% month feels big, wait until you see what silver just did. 20%, and it wasn't gradual.
20.
20.
So why does the smaller metal move that much harder in both directions? Short spikes, but short twisters.
Speaking of sharper moves, silver's the story that stopped me cold.
Go on.
So USA Today clocked silver at $68.35 an ounce on August 20th, an 8.52% jump in a single session.
One day.
One day! And Kitco's now asking out loud whether $100 silver is actually on the table.
Mining.com reported the run towards $70 has mining stocks surging as major banks map out more upside.
Right, an index box found miners like Hecla and Wheaton outperforming, with bank forecasts scattered anywhere from $67 to $118. That's not a forecast, that's a dartboard.
Fair.
So is this analysis, or is Wall Street just chasing the tape at this point?
Some of both, honestly. Silver's a small market. Global mine supply's a fraction of gold's. It doesn't take much money to move it hard.
Which cuts both ways.
Exactly. I watched silver spike this way back in 2011, ran towards $50, then gave back nearly half within weeks. The metal has a habit of overshooting.
So the caution's warranted.
The move's real. Silver just amplifies whatever gold's doing times 2 or 3.
Wait, why though? What makes silver so much twitchier than gold?
2 buyers instead of 1. Gold's mostly a monetary and reserve asset. Silver's that plus an industrial metal. Solar panels, electronics, batteries.
So when investors pile into the debasement trade, they're fighting industrial buyers for the same ounces.
Right, and industrial demand doesn't vanish just because prices spike. Solar manufacturers still need the metal.
So solar demand doesn't back off when the price runs up 20% in a month?
Historically, no. Panel makers lock in longer contracts, and there's not a fast substitute for silver's conductivity.
So retail and industrial buyers end up bidding against each other, not against a fixed supply.
Right, and above-ground silver stockpiles are thinner than gold's. That's part of why the swings run bigger both ways.
Kitco's own reporting ties this to the same thesis we heard on gold, just with an industrial kicker.
That combination's rare, and it's why analysts get cautious calling a top.
Which squeezes supply from both sides at once.
Gold moves on fear and rates. Silver moves on fear and rates and factories.
So this month, both buyers showed up together.
Looks like that. Same catalyst hit 2 very different demand pools on the same day.
And that catalyst, everyone keeps circling back to it, is this Treasury move.
Same day, same spike, gold and silver both. Worth asking what's actually behind it.
So what did the Treasury actually announce?
The metals moved because of one Treasury decision.
Okay, before we go further, what actually is a bond buyback? Because Treasury buying its own bonds sounds backwards.
It's simpler than it sounds. The Treasury Department doubled its long-dated buyback program this week, according to Benzinga.
So they're walking me through it. They're taking cash and purchasing older, long-term bonds that are already out in the market?
Right. And when a big buyer shows up for those bonds, prices rise and yields fall. That's just how bonds work.
And that's the piece that hits the dollar, too. If Treasury's out there buying up debt, that's extra pressure on the currency itself.
Exactly. It isn't new stimulus the way quantitative easing was, but the effect rhymes. More dollars in motion, and gold, priced in dollars, catches a bid.
Right. MarketWatch reported yields dropped sharply the moment traders read the announcement. And they quoted Jill Cetina, formerly with bank supervision at the Dallas Fed, calling it a significant intervention.
That word, intervention, is doing a lot of work there.
Here's what got me. Stocks, bonds, and gold all rallied the same day. Those three don't usually move together.
They don't. Gold typically moves opposite stocks, since it's the safety trade.
So what's the market telling us when all three go up at once?
One read, traders aren't cheering growth. They're cheering Treasury stepping in to backstop the bond market itself.
That signal is about the bond market more than about growth.
It reminds me of Operation Twist back in the early 60s when the Fed tried managing long rates directly to hold down borrowing costs without flooding the system with new money.
How did that work out long term?
It bought time. It didn't fix the underlying debt picture. It just moved who was holding the risk.
So gold's rallying because investors think this buyback is covering for something bigger.
That's the read a lot of desks are making, though it's one interpretation, not a certainty.
AA also reported Treasury yields fell sharply Wednesday, right after the announcement hit.
Same signal, different outlet. When yields fall because of a policy move instead of a growth story, gold tends to like it.
And it's not just bullion catching the bid. The leverage trade on this whole story is the miners.
If the metal moves a few percent, a miner's margin can move several times that.
Which is exactly what happened with Hecla and Coeur this week.
We'll get into those numbers next because that gap between the metal and the mining stocks is the next piece of this puzzle.
Stick around for that.
With that buyback story still fresh, the miners moved.
Fast, too. AOL's David Modell reported Hecla and Coeur both spiked 13% Wednesday on that same news.
For a year, miners lacked the metals, and Wednesday closed a chunk of that gap in one session.
Forbes' Frank Holmes flagged something else this week. Margins widened across producers, even while traditional buyers stayed out.
Is that a real catch-up trade or a one-day pop?
Depends what happens next. There's actual project news backing it up.
Deal Room reported i-80 Gold closed a $500 million financing package to build out its Nevada operation.
$500 million. That's a company betting on production actually showing up.
And Crux Investor reported Cabral Gold won its operating license at Coeur, with first gold now targeted to September 2026, 6 weeks ahead of schedule.
So while gold and silver grab the headlines, the builders are quietly locking in capital and permits.
Financing and licenses are slower signals. They show up in production numbers over the next year once these builds come online.
Okay, what do we watch next week?
3 things. The PCE print, inflation cooling or not, shifts the rate path, and rates move miner margins directly.
What else?
Warsh's tone at his debut, hawkish against this buyback backdrop, creates friction worth watching.
And whether miner strength holds if gold and silver cool off, or if Wednesday was just a relief bounce.
That last one tells you whether the market believes in the metal or just in the moment.
We'll have the answer by next week.
Oh.
Okay, quick gut check. If you take one thing from today, what is it?
That silver's move isn't just gold's little cousin anymore. It's setting the pace.
The 2011 comparison you made stuck with me. Ran hot, then gave back half.
Exactly why we don't chase these moves blind. Watch the volatility, not just the headline number.
And the buyback story, that's the thread tying gold, silver, and the miners together this week.
Hecla, Coeur, i-80 Gold, Cabral, builders moving while the metal grabs the headlines. That's worth tracking into next week.
All right, that's the show. If this one landed for you, subscribe and leave us a review. It helps.
And send us your questions. goldstandard@heymato.com. We read everyone.
Thanks for spending this time with us.
We'll see you next week.